Hey everyone, welcome back to Corporate Decoder, where we make sense of the financial world, one filing at a time. Today we're diving into Odyssey Health Incorporated's latest report. It looks like they've been busy making some important adjustments with their debts, and we're going to break down what that means for the company. But before we get into the nitty-gritty, if you enjoy getting clear, actionable insights from these corporate documents, make sure you hit that subscribe button. And for more real-time discussions and to connect with fellow financial enthusiasts, join our Discord community. The link is in the description below. Let's get straight to it. Odyssey Health Incorporated has filed a Form 8K, which is a report filed when certain significant events happen that shareholders should know about. Think of it as a company's way of giving us a heads up on major changes. The report we're looking at is dated the 30th of January 2026, which tells us when these events officially took place or were reported. Our focus today is Odyssey Health Incorporated, a company that operates in the health sector. Now, while we usually skip over addresses, it is good to know where the company is based. A quick look shows they are headquartered in Las Vegas, Nevada. The company's common stock is traded over the counter or OTC, under the ticker symbol OD. Being on the OTC market can sometimes mean less liquidity compared to major exchanges, but it is where many smaller companies start. The most significant part of this filing is under Item 1.01. This section tells us about entering into important agreements, and Odyssey Health has been quite active here, specifically with amendments to their existing debt agreements. First up, on the 30th of January 2026, the company amended 4 convertible promissory notes. These notes were originally made back in late 2021 with 2 of their directors and 2 of their officers. The key change here is extending the deadline for repayment, or the maturity date, from its original due date to the 31st of January 2027. This effectively means the company has bought itself more time to pay back this debt. Next, also on the 30th of January 2026, they amended another convertible promissory note. This one was originally taken out on the 14th of August 2024 with a company called LGH Investments, LLC. The amendment pushes the repayment deadline for this note to the 30th of April 2026. So, for this particular debt, they've extended it by a shorter period, a few more months. Continuing with that busy the 30th of January, they also amended a convertible promissory note with an accredited investor named Jonathan Lutz. This note was first established on the 13th of February 2024. The amendment here extends the maturity date all the way to the 31st of January 2027, which is a similar longer extension as the one with the directors and officers. Finally, on the 2nd of February 2026, but officially taking effect on the 31st of January 2026, they amended a promissory note with another accredited investor, Peter J. Daruda. This note was dated the 14th of August 2024. The term for this debt has also been extended to the 31st of January 2027. So what does all this mean? Essentially, Odyssey Health Incorporated has renegotiated several of its debts. They've gone back to the lenders, who in this case include their own insiders and external investors, and asked for more time to repay. They've successfully secured extensions ranging from a few months to over a year for these promissory notes. This brings us to Item 2.03, which covers the creation of direct financial obligations. All these amendments we just discussed mean that the company is entering into new agreements that create or modify its financial responsibilities. By extending the maturity dates, they are reaffirming these obligations but pushing the payment timeline further into the future. It is not a matter of creating new debt entirely, but rather modifying the terms of existing debts, which is a significant financial event. Now, this section usually points to supporting documents. This exhibit, number 10.1, is the actual document for the amendment to the notes with the directors and officers. Exhibit 10.2 is the amendment with LGH Investments, LLC. Interestingly, this amendment is dated the 30th of January 2026, but the original note it refers to is dated the 5th of April 2021. Not the 14th of August 2024, as mentioned earlier. This can sometimes happen with broad amendments that cover multiple or amended notes. Then we have Exhibit 10.3, the amendment with Jonathan Lutz. And finally, Exhibit 10.4, the amendment with Peter J. Daruda. It is worth noting that for this particular amendment, the date of the amendment is the 2nd of February 2026, but it is effective on the 30th of January 2026. This suggests a slight administrative delay in formalizing the agreement. And lastly, there is Exhibit 104, which is the interactive data file. This is for regulatory purposes, allowing for easier analysis of the filing data. So, when we look at this filing, especially a Form 8K focused on material agreements, the story is about managing debt. Odyssey Health Incorporated is in a phase where they are making significant adjustments to their repayment schedules. By extending these maturity dates, they are strategically managing their cash flow. This can be a sign that the company may not have the immediate cash to pay off these debts. Or they might be choosing to reallocate their available funds towards other areas of the business, perhaps for growth or to cover operational expenses. It is crucial to understand that extending debt maturity is a tool companies use to gain financial flexibility. It can prevent a cash crunch and allow more time for the business to improve its financial performance before these obligations come due. However, it also means that the company is carrying this debt for a longer period, and depending on the interest rates, it could lead to higher overall interest payments over time. For Odyssey Health, the fact that they are amending notes with both internal stakeholders, like directors and officers, and external accredited investors like LGH Investments, Jonathan Lutz, and Peter J. Daruda, shows a broad need to address their debt. The fact that they secured these extensions suggests a level of trust and a willingness from their lenders to work with the company. Now, let's think about what this means for the company's direction. On one hand, securing these extensions is a positive sign of financial management. It shows they are proactively addressing their financial commitments rather than defaulting. This can preserve valuable relationships with lenders and investors. On the other hand, it raises questions about the company's short-term liquidity and its ability to generate sufficient cash flow to meet its obligations in the coming years. A key risk here is that if the company's financial performance doesn't significantly improve by the new maturity dates, they might face similar issues again, or potentially a more severe situation. Conversely, if they can leverage this extra time to grow revenue, increase profitability, or secure new funding, these extensions could be a very strategic move that allows them to stabilize and then thrive. From a Warren Buffett perspective, we look for companies with strong underlying businesses and good management. The management here is actively managing their financial obligations, which is good. But the underlying need for extensions points to potential cash flow challenges. We need to see if this is a temporary hurdle or a symptom of a deeper issue. The fact that they are extending debt with their own officers and directors could be seen as a sign of confidence from leadership. Or it could simply be a necessary step to avoid immediate repayment issues. Without seeing the actual financial statements, it is hard to say definitively whether this is a strong move or a sign of distress. But anytime a company significantly extends its debt obligations, especially with key stakeholders, it is a signal that warrants a closer look at their operational performance and future revenue projections. The company appears to be prioritizing short-term stability over immediate debt repayment, giving themselves more runway. The critical question moving forward will be how they utilize this extended time to strengthen their financial position. Alright? That is our breakdown of Odyssey Health Incorporated's latest filing. What is your take on these debt extensions and what they signal for the company's future? Do you see this as smart financial maneuvering or a red flag? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps us out. And subscribe for more deep dives into corporate filings. Don't forget to check out the Discord link in the description to join the conversation and connect with our community. Thanks for watching, and we'll see you next time on Corporate Decoder.